Good evening, everyone. We are going to cover the psychology of trading in today's Thursday session. For those who are new, welcome. We do this every Thursday, so stay tuned. The psychology of trading and why so many lose. Taking this from the phrase 90% of traders lose 90% of their capital within the first 90 days. So you're going to find that this statistic reveals a harsh truth in trading. And behind this high failure rate lies complex psychology influencing behavior. So, this is what we want to explore today to see why many traders, especially new traders, struggle, the cognitive traps that they face, and the mindset shifts which can actually improve the chances of success within the market. So, today's presentation is going to be on that in terms of our psychology. We are going to cover this one, and then we'll also move on to market analysis. So we're actually going to break down each and every chart that we do as usual every Thursday. Okay, first things first, you are going to find that we've got, okay, just a moment. Okay, that's fine. You are going to find that there is something known as the allure and the illusion of trading. And one of the things that come in from this, number one, we've got overconfidence. People tend to be very confident, or overconfident rather, as they overestimate their skills, leading to reckless decisions without due analysis. So you find someone, maybe they have won a couple of trades, they feel good about themselves, and they feel that they can actually trade more than they are capable of now. And it tends to let someone overestimate their ability within the market. And sometimes, without proper analysis, they tend to jump in a trade. The other one is loss aversion, that is fear of losses dominating as long as you are in the market. This causes you to hold bad trades too long and avoid cutting losses. This is the hopeful person. They are always in the market wishing that it's going to return into their favor. They keep holding the loss in anticipation that it will bounce back, and sometimes they're even scaling in and scaling in some more with hope that this may change something, but it doesn't. We also have confirmation bias, that is traders seeking information, confirming their beliefs, ignoring contradictory data that could help. This one is critical. You find that someone is always looking for a reason that supports why their decision is right. Remember, the last time we spoke about this, we were telling you to also look into reasons why a trade might not actually go your way. So some, because they seek information confirming their beliefs, they end up ruining things by overfitting a trade that is not in line with whatever is happening in an attempt to try and convince themselves that they are right. We also have gambler's fallacy, that is the false belief that past losses affect future probabilities, and it encourages risky betting patterns. You've lost a lot of trades, and you now want to maybe go all in to kind of cover up for what you have lost. You are believing so much in past losses or in past trades, and you think that those will affect future probabilities. Since you've lost so much, surely the next trade should be a success. Something along those lines. Okay. You also find that there is an emotional roller coaster that happens in the trader's mind, and this is something we need to be mindful of. Number one, we've got greed, that is the impulsive chasing of quick profits, which leads to high risk and poorly timed trades. I do not know why, but some traders, especially within our community, are trying to get rich quick, which is a very big problem. You are very impulsive in your chasing of profits, and you usually enter poorly timed trades. There's also fear, that is premature exit from winning trades or reluctance to exit losers, hoping for a turnaround. So it's actually confusing that you find that when someone is actually doing the right thing or they're in the right direction, they tend to exit prematurely. But when someone is in a bad trade, they try by all means to continue holding, hoping for a turnaround. So that is fear, and that is one of the reasons why 90% are losing. Also have anxiety, that is chronic stress, which clouds judgment and impairs effective decision making under pressure. Some of you have this, where your judgment is clouded by that worry of what if I am wrong, or what if I lose money. You're already going in there with a bad mindset. You also are stressed. Some of you are trying to survive off this. We did mention that you should not risk money that you cannot afford to lose, but some of you are doing it anyway. So that is a reason why you get to sometimes become so anxious when you're approaching trades. We also have euphoria. Now, this one is dangerous. Big wins that create overconfidence and reckless risk taking, undermining discipline. You are on a winning streak, you're on a roll. You feel this is going to go on forever and ever. You start to be overconfident, you start to be reckless, you start to take more risks, you're increasing the lot size, you're aiming higher, and you think that the world is yours, and then the market cooks you immediately and puts you back in place. So, there's a fallacy that says that this game is actually rigged, and we want to look into that. You'll find that it's not actually rigged per se, but there are factors that we need to consider, such as information asymmetry. You find that institutions have access to advanced data and tools unavailable rather, to most retail traders, creating an edge. So these are other players that are in the game. The institutions are also in here, but they have access to more advanced data and tools, which most retail traders may not have. And that is the edge that they have within the market. We also have market manipulation through illegal, sorry. Some large players influence prices to their benefit, marginalizing smaller investors. I'm sure this is more prevalent in Forex. Things such as futures is not very, very present, but around Forex, etc., you may find manipulation. Transaction costs, that is high fees and commissions, quickly erode profits, especially for frequent small trades. Yeah, sometimes if you're with a broker that accepts as high fees and commissions, usually it's not going to be the best. I mean, if you are constantly entering frequent small trades, they get eroded by commissions and trading fees. And that is also something that actually affects your progression as a trader. However, realistic expectations are the path to success. So, number one, what do we need? You need to be patient. We've spoken about this, we continue to talk about this. Trading skills develop gradually, and overnight success is extremely rare and unrealistic. You find many people come into this field with expectations that they're going to get rich quick. They think it's a faster way to get to income, but usually it then becomes one of the ways that they lose most of the money ever in their life. So you need to be patient. You need to understand that trading skill develops gradually, and that overnight success is unrealistic. You need to learn continuously as markets evolve, requiring constant study of trends, news, and new strategies. I mean, we are all aware of the volatility that has been in the market lately due to the issues concerning tariffs, etc. Tech stocks, your Nvidias and the like. All those things are new trends that are happening in 2025, something that was not there in 2024, and something that you need to learn and understand to actually then help you to navigate this better as the markets are continuously changing. Discipline is also another one. You need to have a well-crafted trading plan. We'll not speak much on this because we've already shown each other how to create a trading plan. And you need to follow this one consistently. And it is essential to avoid impulsive errors. If it is not going according to your trading plan and your strategy, you do not take the trade. Simple. We've talked more about this. We will not spend much time on that. You also need to master emotional control. That is, be mindfulness, become aware of emotional triggers to prevent reactive trading decisions. Some of you, when you lose, you are trying to recoup or recover the losses immediately. You need to prevent reactive trading decisions. and you need to be self-aware, knowing what triggers you emotionally. You need regular practice of something that helps you reduce stress and sharpen your focus during volatile market conditions. Meditation is one, but there are many ways to do this to reduce stress as well as enhance your focus during volatile market conditions. Journaling, we created an application for this. Use the application to journal your trades. That's going to help you actually track your progress, know your drawbacks, etc. The reporting feature is going to be there soon, which actually explains to you what you're doing right versus what you're doing wrong. So track your trades as well as your emotions to identify behavioral patterns for improvement. So use the application that we developed. It's actually going to help you substantially on issues concerning journaling. You also need to implement robust risk management, that is to set risk limits. Risk only a small percentage of capital per trade. We spoke about this before. I'm sure those who are aware of this already know that we tend to risk a small percentage of the account per trade, as well as using stop losses, as well as diversifying strategies. So the diversification of strategies comes when we want to spread risk across different markets and asset types for stability. That is maybe having multiple commodities or securities or forex pairs within your portfolio. Having a strategy for ranging markets, having a strategy for trending markets, all those things, having a strategy for slow markets, and having a strategy for when the market is extremely volatile. You need to be ready to face each and every scenario of the market. So the key takeaways and the next steps from this is number one, psychology matters. You need to understand cognitive and emotional biases because this is critical for making better decisions. So that's number one. Number two, you need a mindset shift to cultivate patience, discipline, and realistic expectations. Mind, this is the key word. Realistic expectations is a key word because it's the one that will help you improve your outcome. You need to have realistic expectations as far as your goals and targets for the month, for the day, for the week, for the year, for the next 5 years, etc. Have realistic expectations, and you're going to see that you can actually improve by shifting your mindset towards that. Continuous improvement is another. Commit to ongoing learning and refining your trading approach for long-term success. Like I said, we learn every day. We backtest, we try our strategy, we refine it. Wherever it is, we try and see what we can do to continuously improve on it. And then finally, strategy and risk. So you need to also develop a solid risk management and stick to your trading plan. This is important. You have a trading plan, stick to it. And make sure that you've got a solid risk management. Don't usually go for negative risk management unless you have a really high win rate and it works for you, but I don't encourage that. Our teaching is at a minimum 3:1 risk to reward ratio and higher, which is better, as well as sticking to your trading plan. That is your entry reasons, your exit reasons. All those things should be factored in, your calculation of position sizes. All that is important for you to actually have a solid risk management plan as well as a trading plan. So this is it for today. The idea is if we try and change these things, psychology, mindset, trying to continuously improve as well as our strategy and risk, we don't get to be part of the 90% of people who are losing 90% of the capital. I know that some of you have already gotten out of this. Some of you are quite profitable, and congratulations for that. But most of you need to work on these things so that you also become a part of the 10%, which are actually making money from this and do not become a statistic.